Welcome back to the Explainer. Today, we're doing something really cool. We are stepping straight into a cyberpunk-styled simulated institutional trading desk. We're going to decode a completely fascinating multi-agent AI analysis of MZTI, a major packaged food giant. Imagine a literal war room where highly specialized AI trading models battle it out over raw market data to forge one single high-probability investment strategy. It's a phenomenal way to strip all the human emotion out of a really volatile stock setup. Here is the roadmap for today to help us find our quantitative edge. First, the agent debate deconstructed. Second, a strict technical indicator checklist. Third, the fundamental valuation breakdown. Fourth, the bull versus bear matrix. And we'll wrap it all up with a concrete trade execution plan. All right, let's kick things off with Section 1, the agent debate deconstructed.
So let's pull back the curtain on how these specialized AI agents actually clashed over MZTI's pricing. We get to see a tier-by-tier logical progression in this simulated debate. The aggressive analyst, they pushed for a sharp sell based purely on momentum. To this agent, the trend is just fundamentally broken. But look at the conservative analyst. They agreed on the sell, sure, but for entirely different reasons. Their whole obsession was rigid downside protection and the unproven integration of the recent Botchan's acquisition. To them, just because a deal is closed doesn't mean it brings shareholder value yet.
But then, the neutral analyst steps into the ring, bringing everyone back to earth by highlighting that the underlying fundamentals are honestly just too strong to justify a total panic sell-off. This agent pointed out that treating MZTI like a melting ice cube completely ignores its solid cash generation. Selling aggressively into an already oversold zone is incredibly risky because reflex rebounds are super common in these kinds of setups. Finally, the portfolio manager steps in to synthesize these extremes, reconciling them into an underweight consensus. And this demands disciplined de-risking over a 1 to 3 month horizon. It's really a masterful compromise. You don't fully abandon the position because, hey, the business isn't broken, but you do reduce your exposure down to a below benchmark starter position while the stock is essentially in a prove-it phase. Moving right along to Section 2, our strict technical indicator checklist. Acting as technical market technicians here, let's look at the raw data glowing in our matrix. Price is totally trapped below the 10-day exponential moving average of 129.19, and it's sitting significantly below the 50-day simple moving average at 145.14. That confirms the broader regime remains fundamentally weak. The MACD is at negative 5.26, so downside momentum is slowed a bit, but hasn't flipped. And while an RSI of 31.58 suggests selling exhaustion, the volume-weighted moving average at 131.14 tells us recent rallies just aren't being confirmed by volume. Buyers are definitely not stepping up yet. So what's the implication? Well, the absolute most crucial part is risk management. With the average true range elevated at 4.57, our risk system is basically flashing red. An elevated ATR and a weak trend means extreme volatility. If you're set tight stops right now, you are absolutely going to get whipsawed out of your position by normal daily noise. The explicit trading implication here is that position sizing must be reduced and stops must be widened. If you're going to trade this, capital preservation is paramount. Okay, let's pivot to Section 3, the fundamental valuation breakdown. Unpacking exactly why this is viewed as a resilient premium franchise and not some dying value trap, we really have to look at their robust free cash flow, hitting $70.9 million in the most recent quarter. In a challenging market environment, cash is literally oxygen. This recurring generation gives management massive flexibility to absorb integration costs and reinvest in growth. It's the absolute opposite of a structurally dying business. And the crucial point you really need to anchor on is this massive $201.6 million cash pile sitting on the balance sheet, stacked against a tiny $38.8 million in debt. That creates immense financial flexibility. When your debt-to-equity ratio is only about 3.8%, bankruptcy risk is essentially off the table, and downside risk is significantly reduced from a purely structural standpoint. Now, here is a super important nuance regarding capital allocation. Those aggressive share repurchases are actively shrinking the equity denominator. This acts as a highly supportive floor for earnings per share over time, even when revenue is totally flat. Consistently retiring shares means the remaining slices of the pie are getting inherently more valuable. It's a vital mechanic that artificially boosts metrics like return on equity and EPS, and it's exactly what keeps long-term institutional investors engaged. Let's heat things up in Section 4, the bull versus bear matrix. Let's head up a strict, rapid-fire cross-examination between our simulated researchers. The bull aggressively champions structural consumer lock-in, arguing that in packaged foods, brand quality really matters. They see the Botchan's acquisition as a massive growth lever fueled by that free cash flow. But the bear counters with hard, present-day facts. Revenue was totally flat year-over-year at $453.4 million, and GAAP EPS missed consensus by 13.9%. To the bear, you simply don't reward an unproven acquisition when core execution is slipping. The Bulls' defense to all this? They argue this is literally just a transitional quarter. They believe the market is punishing a temporarily dislocated stock because it's blindly reacting to acquisition-related noise. To them, the real catalyst is just beginning to play out, making the current low price an incredibly inefficient discount. On the flip side, the bear essentially says, show me the proof. They note that until management explicitly proves the Botchan's integration won't result in margin dilution, channel overlap, or excessive promotional spending, the stock remains highly vulnerable. The burden of proof is entirely on management to show that growth can actually be reignited before the market will reward the shares with a higher multiple. Which brings us to our final stop, Section 5, the Actionable Trade Execution Plan. Distilling all this conflict into a concrete, multi-tranche execution blueprint for the next 1 to 3 months, here is the exact sequence. First, keep a below-benchmark starter position. You don't abandon the pristine balance sheet, but you definitely trim exposure. Second, strictly avoid aggressive buying while the price is trapped below those key moving averages. Finally, preserve your capital and patiently wait for a specific technical invalidation rule to be met before adding any meaningful exposure. So, what's the exact signal to shift from a defensive stance back to a constructive, accumulating stance? It's a decisive break back above the 129 to 131 moving average cluster. And crucially, that price action must be accompanied by capitulation reversal volume and improving momentum. Until that happens, the downtrend remains fully in control. So I'll leave you with this final provocative thought pulsing in our quant matrix. When you look at MZTI, are you looking at a fundamentally impaired asset trapped in a downtrend? Or are you looking at a temporarily mispriced, highly profitable brand offering a rare, lucrative entry point once the technicals finally align? Keep a very close eye on that 131 level to find out. Thanks for tuning into this explainer, and we will see you next time.